The gold market just flashed a signal that only appears once every few decades. And if you miss it, you'll be watching from the sidelines as one of the greatest wealth transfers in modern history unfolds right before your eyes. Let me show you what's happening right now, because the mainstream media isn't telling you the full story. They're giving you surface-level price updates, while the real action is happening behind closed doors in central bank vaults, COMEX trading pits, and boardrooms across the globe. Gold just hit its 48th all-time high this year. Think about that for a second. 48 separate occasions where gold broke through to levels never seen before in human history. That's not a rally. That's not a bull market. That's a complete paradigm shift in how the world values money itself. But here's what should really get your attention. While gold was making history, something else was happening that most people completely missed. Central banks purchased 220 tons of gold in just one quarter. That's a 28% increase from the previous quarter. These aren't retail investors buying coins. These aren't hedge funds making speculative bets. These are the institutions that print money, that control interest rates, that see economic data before anyone else. And they're buying gold at a pace we haven't seen since the aftermath of the 2008 financial crisis. Why would central banks be panic buying gold right now? What do they know that they're not telling us? Let me paint you a picture of what's really going on. Imagine you're sitting in a meeting room at the People's Bank of China. You've got trillions of dollars in U.S. Treasury bonds. You're watching the United States add $1 trillion to its national debt every 100 days. You're seeing the Federal Reserve's balance sheet balloon to levels that would have been unthinkable a generation ago. You're watching the dollar being weaponized as a geopolitical tool, with sanctions and freezes becoming standard operating procedure. What would you do? You'd diversify. You'd buy gold. And that's exactly what's happening. But it's not just China. Poland just announced they're accelerating their gold purchases. Turkey has been buying consistently for months. India's central bank is adding to reserves. Even countries that have historically been dollar loyalists are quietly shifting their reserve composition. This isn't a trend. This is a coordinated global movement away from dollar dependence and toward hard assets. Now let's talk about what's happening in the physical market, because this is where things get really interesting. The COMEX, which is the major futures exchange for gold in the United States, has been experiencing something unusual. The amount of gold available for immediate delivery has been shrinking while open interest has been growing. In simple terms, more people are making claims on gold than there is gold available to deliver. This creates what traders call a squeeze. And when squeezes happen in commodity markets, prices don't just rise gradually. They explode. We saw this with nickel a few years back when the London Metal Exchange had to halt trading because prices went parabolic. We saw it with oil when it briefly went negative during the pandemic chaos. And we're seeing the early warning signs in gold right now. Here's why this matters to you. The gold market operates on two levels. There's paper gold, which is what most people trade through ETFs, futures contracts, and certificates. Then there's physical gold, the actual metal you can hold in your hand. For decades, these two markets have traded in relative harmony, but that relationship is starting to break down. Physical gold is becoming harder to source. Premiums on coins and bars have been elevated for months. Delivery times from major mints have stretched out. Meanwhile, paper gold continues to trade with the illusion of infinite supply. But what happens when people start demanding physical delivery of their paper claims? What happens when the music stops and there aren't enough chairs? That's the scenario that keeps precious metals analysts up at night. And it's the scenario that central banks are positioning for by accumulating physical metal while they still can. Let me take you back to a moment in history that rhymes with what we're seeing today. It's August 1971. President Nixon is about to go on television and announce that the United States will no longer honor its commitment to exchange dollars for gold at $35 an ounce. The Bretton Woods system, which had governed international monetary relations since World War II, is about to collapse. In the months leading up to that announcement, something interesting was happening. Foreign central banks, particularly France under Charles de Gaulle, had been exchanging their dollars for gold at an accelerating pace. They could see the writing on the wall. The U.S. was running deficits, printing money to fund the Vietnam War and Great Society programs, and the gold reserves at Fort Knox were dwindling. The smart money got out before the door closed. And when Nixon severed the dollar's link to gold, those who had already converted their dollars to gold were protected. Those who waited, they watched the purchasing power of their dollar holdings evaporate over the following decade as inflation ravaged the currency. We're in a similar moment right now. The signs are everywhere if you know where to look. The difference is that this time, It's not just one country's currency at stake, it's the entire global reserve system. Quick aside here, because this is important. If you're sitting on a significant retirement account, maybe $100,000 or more in a traditional IRA or 401k, you might want to look into how gold IRAs work. I put together a free guide that covers the mechanics, how to move funds without triggering taxes or penalties, and what to watch out for. It's in the description below. Not saying it's right for everyone, but it's worth understanding your options when we're seeing this kind of structural shift in the monetary system. All right, back to what's happening in the markets right now. Because while central banks are buying and physical supply is tightening, there's another force at play that's about to add fuel to this fire. Institutional investors are coming back. Gold ETFs saw massive outflows over the past couple of years as investors chased returns in tech stocks and crypto, but that trend just reversed. We're seeing inflows return to gold ETFs at levels we haven't seen since the pandemic panic. When institutions move, they move size. We're not talking about someone buying a few coins, we're talking about billion-dollar allocations that have to be filled in the physical market. And here's the kicker. The mining supply of gold is essentially fixed. Gold miners produced roughly the same amount of gold this year as they did last year and the year before that. There are no new major discoveries coming online. The easy gold has been found and mined. What's left requires going deeper, processing lower-grade ore, and operating in increasingly difficult jurisdictions. The supply side is inelastic. So you've got fixed supply, increasing central bank demand, returning institutional demand, and a physical market that's showing signs of stress. What do you think happens to price? But let's dig deeper into the mechanics of why this move could be more explosive than previous gold rallies. The gold market has a unique structure that most people don't understand. The majority of gold trading happens in the futures market, where contracts are settled in cash rather than physical delivery. This allows for massive leverage and paper claims that far exceed the actual physical gold backing them. Estimates vary, but some analysts suggest that for every ounce of physical gold, there are anywhere from 100 to 500 ounces of paper claims. This works fine as long as everyone's content to trade paper. But the moment a significant percentage of holders demand physical delivery, the system breaks. We're starting to see cracks. Major bullion dealers have reported allocation delays. Some products are on backorder. Premiums over spot price have widened. These are the early warning signs that the paper and physical markets are beginning to diverge. Now, let's talk about what's happening in the currency markets, because this is the other side of the gold story. The dollar has been the world's reserve currency for over 80 years. But that dominance is being challenged in ways that would have been unthinkable a decade ago. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several new members, have been openly discussing alternatives to dollar-based trade. They're settling oil transactions in yuan. They're creating bilateral currency swap agreements. They're building payment systems that bypass SWIFT, and they're backing these initiatives with gold. This isn't conspiracy theory. This is official policy being discussed at ministerial levels and implemented through central bank actions. The de-dollarization trend is real, it's accelerating, and gold is at the center of it. Think about what this means. For decades, countries needed dollars to buy oil, to settle international trade, to hold as reserves. This created artificial demand for dollars that allowed the United States to run massive deficits without immediate consequences. But if that demand disappears, if countries can trade in their own currencies or in a gold-backed system, what happens to all those excess dollars? They come home. And when they do, the inflation that's been exported abroad for decades comes rushing back to American shores. This is the nightmare scenario that the Federal Reserve doesn't want to talk about publicly, but is absolutely preparing for behind the scenes. Let me give you a specific example of how this plays out. Saudi Arabia, for over 50 years, has sold oil exclusively in dollars under an agreement with the United States. That petrodollar system has been a cornerstone of dollar dominance. But recently, Saudi Arabia has been accepting yuan for oil sales to China. They've been in discussions about pricing oil in currencies other than dollars. The exclusive arrangement is ending. When the Saudis start diversifying away from dollars, every other oil producer will follow. And when oil is no longer priced exclusively in dollars, the demand for dollars drops. And when demand for dollars drops while supply continues to increase through deficit spending, the value of the dollar falls. And when the dollar falls, gold rises. Not in nominal terms, but in real purchasing power terms. This is the macro backdrop that's driving the gold rally. It's not about inflation numbers or interest rate decisions, though those matter. It's about a fundamental restructuring of the global monetary system. And gold is the asset that benefits when monetary systems are in flux. Now let's look at the technical picture, because the charts are telling a story that confirms what the fundamentals are screaming. Gold broke out of a multi-year consolidation pattern earlier this year. It took out resistance levels that had held for over a decade, and it did so on increasing volume, which tells us this isn't a false breakout. This is real buying pressure. The moving averages are all aligned bullishly. The 50-day is above the 200-day, which is a classic golden cross pattern. Momentum indicators are strong but not yet in overbought territory, which suggests there's room to run. And perhaps most importantly, gold is making higher highs and higher lows, the definition of an uptrend. But here's what really catches my attention from a technical perspective. Gold is breaking out in multiple currencies simultaneously. It's not just making new highs in dollar terms. It's making new highs in euros, in yen, in pounds, in Australian dollars. When an asset is rising against all fiat currencies at once, that's not a currency story. That's a gold story. That's the market saying that gold itself is being revalued higher relative to all paper money. This is reminiscent of what happened in the late 1970s. Gold went from $35 an ounce in 1971 to over $800 by 1980. That's not a 20% gain or a 50% gain. That's a 2,000% plus gain in less than a decade. And it happened because the monetary system was in crisis, inflation was out of control, and people lost faith in paper currency. Are we in a similar situation now? The parallels are striking. We've got deficit spending that makes the 1970s look restrained. We've got a Federal Reserve that's trapped between fighting inflation and supporting an over-leveraged economy. We've got geopolitical tensions that are fracturing the post-World War II order. And we've got central banks buying gold like there's no tomorrow. The difference is that this time, the numbers are bigger. The debt is measured in tens of trillions instead of billions. The money printing is measured in trillions instead of millions. The potential move in gold could be proportionally larger simply because the scale of the monetary problem is larger. Let me share something that most people don't know about the gold market. There's a concept called the gold-to-money supply ratio. It's a simple calculation. You take the total value of all the gold ever mined and divide it by the total money supply. This ratio tells you how much of the money supply is backed by gold at current prices. Right now, that ratio is at historic lows, meaning there's more paper money relative to gold than at almost any point in history. The last time this ratio was this low was right before major gold bull markets, in the early 1970s, before gold went from $35 to $800. In the early 2000s, before gold went from $250 to $1,900. The pattern is clear. When there's too much money chasing too little gold, gold's price adjusts upward to restore balance. And we're not talking about small adjustments. We're talking about the kind of moves that create generational wealth for those positioned correctly and destroy purchasing power for those who aren't. Here's another angle that's not getting enough attention. The industrial demand for gold is increasing. Gold isn't just a monetary metal anymore. It's a critical component in electronics, in medical devices, in aerospace applications. As technology advances, the industrial uses for gold are expanding. This creates a floor under demand that didn't exist in previous gold bull markets. So you've got monetary demand from central banks, investment demand from institutions and individuals, and industrial demand from manufacturers. All three sources of demand are increasing simultaneously, while supply remains essentially flat. This is the setup for a supply-demand imbalance that can only be resolved through higher prices. But let's talk about the elephant in the room. The question everyone asks, isn't gold in a bubble? Hasn't it already run too far too fast? Here's how I think about that question. Gold has hit 48 all-time highs this year. But let's put that in context. The stock market has been hitting all-time highs regularly for over a decade. Real estate in major cities has been hitting all-time highs for years. Art, collectibles, classic cars, they've all been hitting records. Everything priced in dollars has been going up because the dollar itself is being debased. Gold isn't in a bubble. Gold is repricing to reflect the devaluation of the currencies it's measured against. When you print trillions of dollars, when you run deficits that can never be repaid, when you create money out of thin air to buy government bonds, the value of that money decreases. Gold's price going up is just the flip side of the dollar's purchasing power going down. And here's the thing. If you adjust gold for real inflation, not the government's manipulated CPI numbers, but actual inflation in the cost of living, gold would need to be significantly higher just to match its previous peak in 1980. Some analysts calculate that inflation-adjusted gold should be over $3,000 an ounce just to equal its 1980 high. We're not there yet. This isn't a bubble. This is gold playing catch-up to decades of monetary expansion. Now, I want to address something that's going to happen as this gold rally continues. You're going to hear people say you've missed it. You're going to hear that it's too late to get in. You're going to hear that gold is due for a correction. And some of that might be true in the short term. Markets don't go straight up. There will be pullbacks. There will be consolidations. But here's what you need to understand. This isn't a trade. This isn't about trying to time the perfect entry and exit. This is about positioning for a structural shift in the monetary system. This is about protecting purchasing power over years and decades, not days and weeks. The people who bought gold at $300 and watched it go to $1,900 didn't time the bottom perfectly. They recognized the trend and stayed with it. The people who bought gold in 2001 and held through 2011 didn't catch every dip and rally. They understood the macro picture and let it play out. We're in the early stages of a similar move right now. Yes, gold has already moved significantly. But if the thesis is correct, if we're witnessing a fundamental repricing of gold relative to fiat currencies, if the monetary system is truly in the process of restructuring, then what we've seen so far is just the beginning. Think about it from a risk-reward perspective. What's the downside? Gold could pull back 10%, maybe 20% in a correction. That's normal market behavior. But what's the upside? If gold follows the pattern of previous monetary crises, if it reprices to reflect the true scale of currency debasement, we could be talking about multiples of the current price. And here's the crucial point. The downside is temporary. The upside is structural. Corrections in a bull market are buying opportunities. Pullbacks in a secular trend are chances to add to positions. The people who understand this are the ones who build wealth during these transitions. Let me tell you about what happened to people who waited during the last gold bull market. In 2005, gold was around $400 an ounce. People said it had already doubled from its lows and was too expensive. By 2008, it was $1,000. People said it was in a bubble. By 2011, it was $1,900. The people who waited for the perfect entry, who tried to time the bottom, who listened to the skeptics, they missed one of the greatest bull markets in history. Don't make that mistake this time. The train is leaving the station. The doors are still open, but they won't stay open forever. At some point, the physical market will disconnect from the paper market. At some point, gold will be unavailable at any price and size. At some point, the opportunity to position yourself will have passed. This is your last call. Not because gold is going to stop going up tomorrow, but because the easy part of this move, the part where you can still get in at reasonable prices with reasonable premiums, that window is closing. Once the mainstream catches on, once the financial advisors start recommending gold, once your neighbors are talking about buying gold, it'll be too late to get in at these levels. The smart money is already positioned. Central banks have been accumulating for years. Institutional investors are starting to allocate. High net worth individuals have been building positions quietly. The question is, are you going to join them, or are you going to watch from the sidelines as the greatest wealth transfer of our generation unfolds? Gold is leaving the station. The fundamentals are aligned. The technicals are confirming. The macro backdrop is supportive. The supply-demand dynamics are favorable. Every indicator is pointing in the same direction. This is as clear a setup as you're going to get in financial markets. The choice is yours. You can wait for more confirmation, for more proof, for more certainty. But by the time you have complete certainty, the opportunity will have passed. The biggest gains in any market are made by those who see the trend early and have the conviction to act on it. This is that moment. This is your chance to position yourself on the right side of history. The monetary system is changing. The world is moving away from pure fiat currency and back toward hard assets. Gold is at the center of that transition. And those who recognize it early, who act decisively, who have the courage to go against the mainstream narrative, they're the ones who will preserve and grow their wealth through what's coming. All aboard. Last call. The train is leaving the station. Make sure you're on it.